Welcome back to Investing Talk Podcast.
Today we're looking at SoFi Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm know that you appreciate the breakdowns we do here.
It definitely does. And today we have well, it's a bit of a head-scratcher, honestly.
Yeah, that's putting it lightly.
We are looking at a situation that I think is confusing a lot of retail investors right now, because there's this massive disconnect.
Right.
SoFi just posted absolute record results for the fourth quarter of 2025. I mean, they finally smashed that $1 billion revenue ceiling for the first time in a single quarter.
Which is a huge psychological milestone.
Huge.
You know, doing $1 billion in a quarter, it puts you in a completely different weight class.
It does. But here's the kicker. Despite hitting that milestone, despite the massive growth, the stock has dropped significantly.
Yeah.
We're talking about a 28% decline in just the last 30 days alone.
Yeah, I've been watching this chart, and it is just ugly.
Very ugly.
It's that classic fintech volatility we all love to hate. But I think this is the big question for today, right? It's like, is this drop a warning sign?
Meaning the market sees something we don't.
Exactly. Like maybe there's a crack in the plumbing somewhere. Because usually when a stock tanks on quote-unquote good news, it means the news wasn't actually that good.
Or it's just a massive overreaction.
Right. A panic that's creating a ridiculous buying opportunity.
And that is our mission today. We need to figure out if the 2026 guidance, which is very ambitious, by the way, justifies a bullish reversal here, or if investors should just stay away and let the knife fall.
All right, well, let's not just guess. Let's look at the actual numbers. Because, as we know, record results can sometimes just be headline dressing. I want to know what is actually happening under the hood here.
Sure.
Is this real growth, or is it just accounting gymnastics?
It's not just dressing this time. The top-line momentum is, objectively speaking, exceptional. For Q4 2025, they reported adjusted net revenue of $1.013 billion.
Wow.
Yeah, that is up 37% year over year.
Okay, 37% growth at that scale is impressive. Usually, as companies get bigger, gravity kicks in.
The law of large numbers.
Exactly. Growth slows down. How did that $1.013 billion compare to what Wall Street was expecting?
They beat the street. Consensus estimates were sitting roughly around $984 million, so they cleared that comfortably.
Nice.
But what's more important for our thesis today is what they are telling us about the future. Management is projecting approximately $4.655 billion in revenue for the full year of 2026.
Let me just run the math on that real quick.
That implies
30%
year-over-year growth rate.
continuing into 2026. That is aggressive.
It is very aggressive. And that is where the growth story really gets its legs. But you know as well as I do, not all revenue is created equal.
Right.
In fintech, if you're just lending money, you're extremely vulnerable. If interest rates spike or people just start paying you back, that revenue evaporates overnight.
Absolutely, because if you're just holding loans on your balance sheet, you're capital constrained. You literally run out of money to lend out, or you take on massive credit risk. We saw this with all the peer-to-peer lending platforms that imploded a few years ago. They were just risky shadow banks disguised as tech companies.
Precisely. And this right here is the secret sauce of this report that I think the broader market is just overlooking right now. The quality of their revenue is shifting.
How so?
They have this segment called fee-based revenue. This includes their loan platform business where they actually sell the loans, plus their brokerage fees, interchange fees, referral income, all of that.
Okay.
This specific bucket grew 53% year over year in Q4, hitting $443 million.
Let's unpack why that matters for you listening at home. Why do we care so much about the fee-based revenue side of the house?
Think of it like this. The old model was renting out cars. You own the car, you take the financial risk if it crashes, you pay for the maintenance. That's lending.
Right.
Fee-based revenue is like being the toll booth on the highway. You don't own the cars driving through, you don't care if they crash miles down the road, you just collect a guaranteed fee every single time money moves past your gate.
It's capital light and incredibly high margin.
Exactly. So they are becoming less of a traditional bank and way more of an actual tech platform.
Which means they generate cash without tying up their own balance sheet. It makes the earning so much more durable.
Yes.
That actually brings us to the profitability question. Because for years, the primary knock on SoFi, and frankly, every single neobank out there, was growth at any cost.
Oh yeah, burning cash to acquire users.
Exactly. They would spend $1 in marketing to make 50 cents in revenue. Is that still happening? Because I'm always highly skeptical when tech companies start bragging about adjusted EBITDA. It
Yeah.
usually just means earnings before interest, taxes, depreciation, and all the bad stuff.
That's a fair skepticism to have, but the unprofitability narrative is totally dead here. Just look at the margins. Adjusted EBITDA margin hit 31% in Q4.
31%.
Yeah. And for 2026, they are guiding to roughly 34%. This is textbook operating leverage in action. As they get bigger, they get exponentially more profitable because their fixed costs, like their core tech snack, just don't go up as fast as their revenue does.
And does that actually trickle down to the real earnings per share? Because EBITDA is nice on a slide deck, but I can't pay my rent with EBITDA.
Yeah.
I need to know if there is real GAAP income at the bottom of the page.
It definitely does. They are projecting GAAP EPS, so real unadjusted earnings, of 60 cents for 2026.
And what was the street expecting for 2026?
The average analyst estimate was roughly 58 cents, so they are actively guiding above consensus.
Okay.
And just to give you some context on the velocity of this turnaround, in Q4 2025, EPS was just 13 cents.
Wow.
So jumping to 60 cents for the full year 2026 is explosive earnings growth. It's effectively a quadrupling of their baseline earnings power.
Okay, so the P&L looks fantastic. But I want to talk about the balance sheet for a second. Because if we rewind back to the whole bank charter moment a few years ago, the entire bull argument was that becoming a heavily regulated real bank would give them a moat.
Right.
Is that actually playing out in the data, or was it just a marketing stunt to sound more legitimate?
It's not a stunt at all. It's the cornerstone of their financial health right now. Their deposits surged to $37.5 billion in Q4.
That is massive.
It is. That is up $4.6 billion sequentially, just from the previous quarter.
And the reason that matters so much, for anyone wondering, is the cost of funding. If you are a standard fintech without a formal bank charter, you have to borrow your money from Wall Street to lend it out to your retail customers. And wholesale money is very expensive.
Exactly. Imagine you're just a lending shop. You borrow money from a big prime broker at 6% just to turn around and lend it to a consumer at 8%.
Your margin is incredibly razor thin.
Right. And if rates move against you, you're wiped out. But with the bank charter, SoFi takes in everyday customer deposits through their checking and savings accounts, and they pay those users maybe 3 or 4% interest.
Then they lend that exact same money out at 8 or 9%.
Yes. They completely cut out the Wall Street middleman. Actually, they became the middleman. With $37.5 billion in customer deposits, they can fund their own lending engine incredibly cheaply.
And that is why their net interest margins, or NM, are staying above 5%. That is a very, very healthy margin for any bank. They simply aren't reliant on expensive wholesale funding anymore.
It's a fortress balance sheet at this point.
It sounds like it. But are the retail customers actually sticking around? Or are they just chasing a high promotional yield on a savings account and then fleeing the moment rates drop?
The data strongly suggests they are sticking around. They added 1.0 million new members in Q4 alone. That brings their total user base to 13.7 million members.
That's solid growth.
It is, but the metric I really love is total products adopted. They have over 20 million total products adopted now across those 13.7 million members.
So that means the average customer isn't just using them for one isolated thing. They might have a checking account, plus a student loan refinancing, and maybe an active investing account too.
Right, and that cross-selling is the absolute key to the financial super app argument. It makes the ecosystem so incredibly sticky.
Because of the switching costs.
Exactly. Once you have 3 or 4 products tied up with SoFi, your direct deposit is hitting there every Friday, your auto loan is auto-deducting, your credit card is there. You aren't leaving to go to a legacy competitor just because they offer a slightly better savings rate for 3 months.
It's just too much of a headache to move your entire financial life.
The switching costs become way too high mentally.
Okay, so fundamentally, the company seems to be firing on all cylinders. Revenue is up, margins are up, deposits are way up.
But here comes the pivot.
And this is a big but. The stock chart looks like a total crime scene. Let's shift gears and look at the technicals. Pivot to the charts for a second. What is the price action actually telling us?
Yeah, it's been a violent roller coaster lately.
Roller coaster's putting it very mildly. If we just rewind a few months to November 2025, the stock was flying high in the high 20s, maybe low 30s.
Yep.
It officially peaked at $29.90 in early January 2026. Everyone on the forums was celebrating. It genuinely felt like the long-awaited breakout was finally real.
And then gravity kicked in.
Hard.
Mm-hmm.
As of mid-February 2026, we are sitting at roughly $19.67. That is a 28% decline in just the last 30 days.
It's painful.
And this all happened while they were releasing this fantastic earnings news. That's the part that really scares people. Why the massive sell-off if the numbers are so good?
It's a harsh technical correction, but when we look at the technicals, we always have to look for structural support. Where does the bleeding mathematically stop? Because nothing falls in a straight line forever.
Right, so looking at the historical levels, that $18 to $20 range looks pretty critical.
It is extremely critical. Market commentary and most technical analysis suggests that this specific zone was massive previous resistance.
Remember back when it struggled to break $20 for the longest time?
Oh yeah, it would hit $20 and instantly sell off.
It was an absolute ceiling for over a year.
Well, now that it's finally broken through that ceiling and come back down, that old ceiling often becomes the new floor. It's just simple market psychology at play.
Right, because people who sold at 20 before and watched it run to 30 without them are now desperately looking to buy back in at that exact same level.
The classic resistance becomes support flip.
Exactly.
It's a key reversal zone. If you are a technical swing trader, this is exactly the setup you look for. You have a stock that has fully retraced to a major historical support level, but the underlying fundamentals haven't deteriorated at all. In fact, the fundamentals have actually improved.
Is there any concrete sign that big institutional money agrees with us? Because retail investors catching a falling knife on a hunch is one thing. I want to know if the real institutions are stepping in. Are the whales buying this dip, or are they the ones dumping?
We are definitely seeing some interesting signals on the institutional side. There have been several mentions of whale alerts in financial stocks recently.
Really?
Yeah, and this usually suggests that institutions, hedge funds, pension funds, they are actively accumulating shares at these artificially depressed levels.
That's always the tell, isn't it? The price drops, retail panics, and sells the bottom because they see red in their portfolio. And the whales just quietly scoop it all up on the cheap. It literally happens every single cycle.
That is the primary technical thesis here. The setup creates an incredible asymmetric risk-to-reward ratio.
Meaning the downside is protected.
Right. The stock has already priced in a ton of localized negativity. A 28% drop implies something is fundamentally wrong. But if the earnings and the guidance are actually good, then the downside risk from $19 is very limited.
While the upside, if it just purely reverts back to where it was in January, is massive.
Significant upside, exactly.
Okay, so the charts heavily suggest we are at a floor, but let's transition and see what is the street saying. Because sell-side analysts can really drive these short-term algorithmic moves. Are they suddenly downgrading the stock?
Not at all. The consensus is actually quite constructive, which makes the recent price drop even stranger when you think about it. The average price target across roughly 20 different brokers is currently $25.44.
So if the stock is sitting at $19.67 today, that implies about 29% upside just to get back to the average analyst target.
Correct. And keep in mind, that's just the average. If you look at the really big players, the bulls are very, very bullish.
Like who?
JP Morgan recently upgraded SoFi to an overweight rating with a $31 price target.
$31. That's massive upside from here. That's almost 60%.
Yeah, and Citizens JMP raised their target to $30 with an outperform rating. Both of those institutional desks explicitly cited that impressive EBITDA growth we talked about earlier.
They believe the shift to profitability is real and sustainable.
Exactly. And getting a stamp of approval from JP Morgan is highly ironic, but extremely valuable.
Because they are the ultimate legacy bank.
Right. The biggest bank in the world is essentially telling their clients, hey, this fintech challenger is actually legit.
But surely there's a bear in the room. Who hates this stock right now? There's always someone calling for doom.
Hate might be a strong word, but Truist Securities is definitely playing the cautious role. They maintained a hold rating and actually lowered their price target recently down to $21.
Okay, but listen to that. Even the bear case is $21. We are trading at $19.67. So the most pessimistic analyst on the street still fundamentally thinks the stock is undervalued right now.
It really says a lot about the margin of safety here. It suggests the floor is solid. Truist is basically saying, we see some near-term execution caution, but they aren't calling for a structural collapse. They aren't saying it's going back down to $10.
What about the purely quantitative Valuation models. I know we always like to look at the independent math, not just the analyst opinions, because analysts have their own banking agendas.
Uh-huh.
What does the raw, unbiased data say?
If you look at the TIKR valuation model, it gets pretty wild. They have a mathematically derived target price as high as $36.57.
Whoa, that implies what? Something like 87% upside.
Yes, and that is strictly based on a discounted cash flow model, assuming a 22.9% compound annual growth rate for revenue and operating margins stabilizing around 25%.
Which they are already beating on the margin side.
Exactly. So if SoFi just executes on that baseline math, the stock is dirt cheap right now. Even simply Wall Street, which is traditionally a very conservative platform, suggests a fair value of $26.75 based on future cash flows.
So almost every single model and every analyst, except the most bearish outliers, thinks the stock is severely undervalued at roughly $19.
Exactly. And when we look at the general news sentiment right now, it totally backs that up. We are consistently seeing headlines like market overreaction and opportunity ahead.
Though I imagine there is some noise.
Of course, there are some neutral pieces discussing the competitive landscape, but the aggregate media sentiment is heavily neutral to bullish.
Which perfectly brings us back to that contrarian opportunity. When the price action is absolutely terrible, but the underlying sentiment and the hard fundamentals are excellent, that is usually where you want to be looking for entry points.
Right, but we have to be responsible here. I definitely don't want to paint a picture that this is just a risk-free lottery ticket.
Let's play devil's advocate then. Where does this whole thesis go wrong? Because a 30% drop in a month doesn't happen for literally no reason. What are the major risks to this turnaround story?
Well, the first and absolutely biggest risk is simply execution. Management has set a very, very high bar for themselves.
They have. They've essentially painted a target on their own back.
30% top-line revenue growth in 2026, a 34% EBITDA margin. Those are incredibly aggressive targets for a company of this size and maturity.
If they miss that, if they stumble even a little bit next quarter, the market will severely punish them. We've seen it 100 times in the tech sector. A company boldly guides for 30%, they only deliver 25%, which is still objectively great growth, and the stock drops 20% overnight.
It's true. They are priced for absolute perfection in terms of those forward growth rates. If new member growth slows down, say they abruptly drop below that 1 million new members per quarter pace, or if we suddenly see credit quality drop in their personal loan portfolio, the stock could easily retest the $15 to $17 range.
And let's talk about that credit quality for a second. If the broader macroeconomy takes a nosedive, people naturally stop paying their unsecured personal loans first. SoFi has a lot of direct exposure there.
That is the macro risk, yes. Now, they do intentionally target high-quality borrowers. We are talking high FICO scores, high annual income. But realistically, nobody is totally immune to a deep, prolonged recession.
Fair point. And we really can't ignore the sheer scale of the competition either. I keep hearing constantly about new holdings. They seem to be the absolute darling of the global fintech world right now.
News a total beast.
They are growing users at a 27% compound rate. They are completely dominating Latin America, and they are inevitably coming for the U.S. market eventually. Plus, traditional banks aren't just slipping at the wheel anymore.
No, they've woken up.
Chase, Bank of America, they're actively copying all of these standard fintech features. They have much better mobile apps now. They have early direct deposit. They have no overdraft fees. Is the U.S. market just getting far too saturated for SoFi to keep growing at 30%?
It's a very valid concern. But here is the structural rebuttal to that saturation argument. SoFi has something that the vast majority of those shiny new competitors don't. They have the complete integrated ecosystem backed by that massive $37.5 billion deposit base.
A super app structure.
Exactly. A lot of the new competitors out there are just point solutions. Maybe they just do really good personal lending, or they just do slick crypto trading.
Right.
SoFi literally does everything in one place. That creates what analysts call a highly defensible ecosystem. It's significantly harder for a user to leave SoFi than it is to just delete a standalone stock trading app from their phone.
That's a totally fair point. The super app strategy is a defensive moat in and of itself. Now, there is one major wildcard we haven't touched on yet. It's highly speculative, but honestly, it could be huge.
You're talking about the crypto play.
Right. There are persistent rumors and some very strategic hires suggesting a potential bank-issued stablecoin and a massively expanded crypto trading desk.
It is entirely unconfirmed by management in terms of a full public rollout, but the technical infrastructure is undeniably there.
And the regulatory advantage.
Precisely. Because they are a fully chartered bank, if they legitimately issue a stablecoin, it inherently carries a level of trust and legitimacy that other offshore crypto projects just don't have.
Imagine a stablecoin fully backed by a federally chartered U.S. bank. That is an absolute game changer for institutional crypto adoption.
But that thesis relies entirely on U.S. regulation clearing up.
It does. It's high uncertainty. But if the regulatory clouds actually part in Washington, that is a massive upside catalyst that is currently valued at zero in the stock price. The market isn't paying a single premium for it yet.
Which just adds to the upside potential.
Okay, so we have laid out the fundamentals, the technical charts, the street sentiment, and the major risks. Time for the final verdict. Put it all together for us.
Looking at the entire holistic picture, I am confidently assigning this a bullish score of 8 out of 10.
That's a really strong score. Walk us through the final thesis.
Here is the absolute bottom line for you listening. SoFi has successfully achieved profitable scale. This isn't some hypothetical, maybe we will make money in 5 years kind of company anymore.
The story has changed.
They are doing it right now. They have record top-line revenue, 31% operating margins, and they are trading at a massive discount, anywhere from 29 to 87% upside, depending on which mathematical model you trust the most.
And all of that discount is purely because of temporary sentiment headwinds and technical selling pressure over the last 30 days.
Exactly. Plus, the strategic shift toward fee-based revenue structurally de-risks the entire business model. It makes them far less sensitive to whatever the Federal Reserve does with interest rates.
So what is the actual actionable strategy here?
This specific setup is absolutely perfect for a swing trade directly into the Q1 2026 earnings print, which will happen in late April.
So you're essentially buying the current fear, fully expecting the next quarterly earnings report to mathematically prove that the growth thesis is still totally intact.
Yes. The current $18 to $20 zone we are in right now is a very favorable asymmetric enter point.
The risk reward is there.
I would look to scale in here, ride the inevitable technical recovery into that April earnings print, and honestly, this stock genuinely has the legs for a 6 to 12-month hold. If the 2026 guidance actually holds up quarter by quarter, this stock should be trading significantly higher by the end of the year.
It's the absolute classic buy the dip scenario, but instead of just hype, it's actually backed by $1 billion in quarterly revenue.
I couldn't have summarized it better myself. That is the breakdown on SoFi.
Thanks for listening, everyone. Make sure to subscribe, like, and comment to catch the next analysis we do.
But before we officially log off, here's one final thought for you to chew on this week. We spent a lot of time today talking about SoFi building this ultimate financial super app.
Right.
If they actually pull this off globally, if they successfully bundle cheap lending, investing, zero-fee banking, and payments into one single seamless digital layer, what actually happens to the traditional brick-and-mortar banks?
They become obsolete.
We might look back at this $20 stock price 5 years from now and realize the broader market wasn't just underestimating SoFi's growth, it was completely underestimating the actual extinction event facing the old financial guard.
That is a massive if, but it is definitely worth watching closely. We'll see you next time.